300 to 850. That's the entire range. Somewhere inside it, a single number quietly decides what interest rate you pay, whether you get approved for an apartment, even your car insurance. Most people know their credit score exists. Almost nobody knows how it's calculated. It's not a mystery, and it's not random. It's a formula. 5 specific factors, weighted in fixed proportions. Run against your financial history every time a lender pulls your file. This is the real breakdown. The 5 factors, the exact weights, and what actually moves the number. Most credit scores in the US come from one company's formula, FICO. FICO scores are built from 5 categories, each with a fixed weight. Payment history, 35%, the single largest factor by a wide margin. Have you paid what you owed on time in the past? One late payment, 30 days or more, can knock points off immediately. It can sit on your credit report for up to 7 years. More serious events, up to 10. Amounts owed, 30%. This trips up more people than any other factor. It's about your credit utilization, how much of your available credit you're actually using. The common guidance, stay under 30% utilization, under 10% for the strongest score. Length of credit history, 15%. Your oldest account, your newest account, and the average age across all of them. This is why closing your oldest card, even one you rarely use, can quietly hurt you. New credit, 10%. Every application triggers a hard inquiry. A cluster of them in a short window signals risk, even if you're managing everything responsibly. Credit mix, 10%. Having a mix of account types shows lenders you can handle different kinds of credit. Here's the detail that catches the most people off guard. Your utilization isn't measured once, it's recalculated every billing cycle. You could pay your balance in full every month, on time, and still see a lower score than expected. Simply because your statement happened to close on a day when your balance was high. This is why some educators recommend paying down your balance before the statement closing date, not just the due date. The due date determines whether you pay interest. The statement closing date is often what determines what number actually gets reported to the bureaus. And end up with visibly different scores, purely based on timing they never thought to think about. The formula isn't frozen, it's evolving, and 2026 has brought 2 real changes. First, buy now, pay later loans. As of late 2025, certain FICO models began factoring BNPL activity into your score for the first time. Used responsibly, it can help people with thin credit files start building a track record. Used irresponsibly, it now carries the same risk a missed credit card payment would. Second, alternative data. Newer models are factoring in rent, utility bills, even telecom payments. Data that never used to touch your credit file at all. For people with little to no traditional credit history, this is opening a door that used to be closed. If you've been paying rent on time for years with nothing to show for it, that's starting to change. There's also FICO 10, a newer model that looks at your credit behavior over a full trailing 2-year window. Meaning a recent pattern of rising balances can start affecting your score even before you technically miss a payment. Given the actual weighting, here's what genuinely moves the number, and what doesn't. Closing an old credit card feels responsible. It often isn't. It shortens your average account age, hitting the 15% length of history factor. And it reduces your total available credit, which can spike your utilization even if spending hasn't changed. Applying for several new cards to chase sign-up bonuses feels savvy, but it isn't free. Each application triggers a hard inquiry. Clusters of them read as risk-seeking behavior. Carrying a small balance on purpose because someone said it helps your score is simply false. What helps your score is using credit and paying it off, not paying interest unnecessarily to prove you're a borrower. Medical debt has its own rule worth knowing. Under current policy, medical collections under $500 should not appear on your credit report at all. If one shows up anyway, it's disputable and worth disputing. This is the part that makes the algorithm worth understanding. The score doesn't just gate credit card approvals. It directly shapes the interest rate on every major loan. A mortgage, an auto loan, a personal loan. The gap between a good score and an excellent one can mean tens of thousands of dollars in interest for the same loan. In many states, it factors into your car insurance premium. Landlords increasingly pull it before approving a rental application.
Thank you.
Some employers in specific industries are legally permitted to review a modified version of it during hiring. A 3-digit number, quietly touching nearly every major financial decision in a person's adult life. 300 to 850, 5 factors. Fixed weights that have stayed remarkably stable for years. None of it is random, and none of it is unknowable. It's math. Math that rewards specific, learnable behaviors. Now you know the actual formula. What you do with the number is up to you. Hit that like button right now. Not for me. Share it. Send it to someone. The more people understand, the harder it becomes to keep hidden. Like, share, follow.
Be sure to like, share, and follow.